Hey everyone, and welcome. Today we're diving deep into a massive part of the financial world, fixed income. Now, if you're studying for your NISM Series XA certification, you are in exactly the right place. We're going to break down all the key concepts from Chapter 9 to help you not just pass that exam, but to really truly get how this market works. All right, let's jump right in. So here's our game plan for today. We're going to kick things off with the absolute basics of the debt market. Then we'll get into the nitty-gritty of bonds and all the different risks that come with them. After that, we'll get into a little bit of math with bond pricing and yields. From there, we'll take a tour of the fixed income markets. And then we'll wrap everything up with a quick review to make sure it all clicks. Let's get to it. All right, first things first, the debt markets. You can kind of think of this as the essential plumbing of our entire economy. It's the system that channels money to where it's needed for growth and operations. So what is it exactly? Well, the debt market is basically a giant marketplace where entities, big corporations, even governments, go when they need to borrow money. They do this by issuing what are called debt securities. Investors like you and me can buy these securities, and in doing so, we're basically the lender. In return for that loan, we get regular interest payments. The key difference from, say, the stock market is really simple. Debt is a loan, while equity means you own a piece of the company. Okay, so let's zoom in on the star of the show in the debt market, the bond. And just like any investment out there, it comes with its own set of risks. And trust me, you absolutely need to know what they are. At its very core, a bond is just a formal IOU. It's a promise. An issuer, the borrower, promises to pay you, the investor, a fixed amount of interest over a set period of time. That interest is called the coupon. Then, at the end of that period, on what's called the maturity date, they promise to give you your original investment back. That's the face value. It's really just a simple contractual promise. Now for the big one, probably the most important risk in the bond world, interest rate risk. Just imagine you own a bond that pays you a 6% coupon. Then, the central bank raises interest rates, and all the new bonds being issued are now paying 8%. Well, all of a sudden, your 6% bond looks a lot less attractive, doesn't it? And because of that, its price, its value on the open market, is going to fall. So the crucial takeaway here, and you've got to remember this, is a simple inverse relationship. When market interest rates go up, the prices of existing bonds go down. And of course, the opposite is true too. This is one of the most fundamental concepts in all of fixed income investing. Next up, we have credit risk, which you'll also hear called default risk. This one is all about a simple question. Is the borrower going to be able to pay you back? It's the risk that the company or the government that issued the bond might run into financial trouble and, fail to make its promised payments. Now, credit risk comes in a few different flavors. First, there's downgrade risk. This happens when a rating agency decides an issuer looks a bit shakier financially, so they lower its credit score. That signals more risk and makes the bond less valuable. Then there's spread risk. This is when the gap between the yield on a corporate bond and a super safe government bond gets wider. It just means investors are demanding more reward for taking on that extra risk. And of course, the worst case scenario is default risk. The issuer simply can't pay. And there are a few other risks to keep on your radar. Reinvestment risk is the danger that when your bond matures, you'll have to reinvest that money at a lower interest rate than before. Call risk is when an issuer decides to pay back your bond early, which they usually do when rates have fallen, leaving you with cash you have to invest somewhere else at a lower yield. Liquidity risk is the fear you can't sell your bond quickly without having to slash the price. And finally, you have inflation and exchange rate risk, which can both just eat away at the real value of your returns. Okay, let's move on and crunch some numbers. How do you actually figure out what a bond is worth today? This all comes down to something called valuation. So the big question is, how do we calculate that fair price? Well, the answer lies in a concept called present value. And it's all based on one fundamental idea. Money today is worth more than the same amount of money in the future, right? $100 in your hand today is better than a promise of $100 a year from now because you can invest today's money and let it grow. Now, I know this might look a little complex, but the principle is actually pretty simple. See, a bond is nothing more than a series of future cash flows. You get the regular coupon payments, and then that final principal repayment. To find its price today, we can't just add those up. We have to discount each of those future payments to figure out what they're worth in today's money. And that's the core of how you value a bond. So it boils down to a pretty simple three-step process. First, you just map out every single payment you expect to get over the entire life of the bond. Second, you take each one of those payments and you apply a discount factor to find its present value. And third, you just add them all up. That final sum, that's the theoretical fair price of the bond. And here we can see that process in action. So in this example, we have a bond paying a nice 10% coupon. But the current market yield for similar bonds is only 8%. Because our bond pays more than the going rate, investors are willing to pay more for it, a premium. So after we discount all those future 10 rupee coupons and the final 100 rupee principal at that 8% market rate, the sum comes out to about 108 rupees. It trades at a premium simply because its coupon is more attractive than what you can get elsewhere right now. Now that we've got a handle on price, let's flip the coin and look at yield. Price is what you pay, but yield is what you earn. It's how we measure the return on our bond investment, and believe me, there's more than one way to look at it. Okay, pay close attention here because this table is pure gold for your exam. It shows the relationship between a bond's coupon rate, its current yield, and its total return, the yield to maturity, or YTM. If a bond sells at par, meaning at its face value, all three are the same. Simple. But if you buy it at a discount for less than face value, your overall return, the YTM, is going to be higher than the coupon rate. And on the flip side, if you pay a premium, your total return will be lower than that coupon rate. You've got to get this logic down. And this brings us right back to that fundamental seesaw relationship we talked about. Price and yield move in opposite directions. I'll say it again because it's that important. As a bond's price goes up, its overall yield goes down. It just makes sense, right? If you pay a higher price for the same stream of cash flows, your effective rate of return has to be lower. All right, let's talk about the yield curve. This graph is really just a simple plot of the yields of bonds against their different maturities. A normal, upward-sloping curve, just like this one, tells us that investors demand higher yields for tying up their money for longer. And that makes sense. It compensates them for taking on more risk over a longer period. This curve is also a really powerful indicator of what the market thinks is coming for economic growth and inflation. Okay, so we've got the theory down, but where does all this trading actually happen? Let's take a quick tour of the actual markets where these securities live. The fixed income world is pretty much split into two main areas. You've got the money market, which is all about short-term borrowing and lending. We're talking instruments that mature in 1 year or less. Then you have the capital market, which is for the big long-term stuff, like financing a new factory. These are securities with maturities longer than a year. Now, the biggest fish in this pond is, without a doubt, the government. They issue all sorts of securities, called G-SECs. These can be short-term things like treasury bills or long-term ones like dated securities. They also include some interesting stuff like strips and sovereign gold bonds, which are actually tied to the price of gold. And because they're all backed by the full faith and credit of the government, they're considered the absolute safest investments out there. Whew! Okay, we have covered a ton of ground. So let's do a quick-fire review of the most critical concepts, just to help lock them into your brain. And I'll leave you with this final thought, a key question for you. We know that interest rate risk is a huge deal, but how do we measure a specific bond's sensitivity to it? The answer is a concept called duration. Simply put, the higher a bond's duration, which is expressed in years, the more its price is going to swing when interest rates change. It's an absolutely essential metric for managing risk in a bond portfolio. And that's our explainer for today. Keep reviewing these concepts. You've got this, and good luck with your certification.